Good morning, everyone. It looks like it's just after 10 o'clock. I think we can get started here. Today, Carrie is going to talk about federal and state filing requirements. For our newer viewers, I want to take a moment to introduce our not-for-profit team here at DWD. My name is Tyson Moore. I'm accounting supervisor in the not-for-profit division. Joining us today is Phil McKenzie, director, and our presenter and partner, Carrie Minnick. I've got a couple of housekeeping items to go over as well before we start. This webinar is live. It's interactive. So for those of you who have questions during today's webinar, you can use the Zoom's question and answer feature. You should find that at the bottom of your screen on the toolbar. We will be answering questions throughout the presentation. Also, Carrie's slides will be emailed to everyone attending the webinar today after the presentation is finished. All right, Carrie, are you ready to start?
I'm ready. Thanks, Tyson.
Yep, thank you.
All right, everyone. Thank you for joining us today. Today, we're going to talk about federal and state filing requirements for nonprofits. And what I've done is kind of divided up the session into some, we're going to go over some forms, the actual forms, what they are, when you need to file them. I've divided them up into just some basic general forms for nonprofits, the annual filings that need to be done, forms related to sales tax, property tax, payroll, and then how to report changes to the IRS. Now, obviously, we are not going to go over every single form that a nonprofit may have to file, but I wanted to point out some of the more common ones that most nonprofits do need to file. So we'll start with the basic forms. So the first, in these basic forms, probably a lot of you have already filed these. You don't need to necessarily refile these again, but just kind of want to talk about what these are. So Form SS4 is the application for employer identification number. So really, this is your, social security number for your organization. And this would have been filed at the very beginning of your organization's history when it first got started. So again, most of you probably don't need to really do anything more with this. You have your EIN, but this is how you got it. A form was filed with the IRS at the very beginning. Next is the Articles of Incorporation. So once an organization gets that EIN number, they need to file with the Indiana Secretary of State to register as a nonprofit. And this again is before doing anything with the IRS. We first need to register with the state. And we do this, we can either do it online or by mail, and there is a filing fee. So again, all of you that are already been incorporated have already filed these with the Secretary of State. However, sometimes you may have to do an amendment to your articles. So some of you may have done this over the years, or it might be something that you may need to do in the future. So if you have any kind of significant changes to your organization, the name, address, year-end, that type of thing, you might have to file an amendment to the Articles of Incorporation with the Secretary of State. This can be done online or by mail. We're going to talk a lot today about the option to file either online or by mail. I always recommend filing online because it is a lot faster and you probably get a response in a more timely fashion. There is a $30 filing fee if you do have to file an Articles of Amendment with the Secretary of State. So in the beginning, after a nonprofit files its articles, it then is able to file an application of recognition of exemption with the IRS. So basically, this is the form that you file with the IRS to get your tax exempt status. So again, all of you that are already a nonprofit, a 501c3, you have already done this. You've already filed this. It is a very large form. It requires a lot of information. There's a $600 filing fee. It must be filed through pay.gov currently, so it is an electronic form. So if there is some reason that you would lose your tax exempt status, you might have to go back and refile this form. So if you do, this is the form that you would refile. And again, it would be online through pay.gov. For I guess that 1023, as I said, it's a very large form with a lot of different pages. And when you go to file it, there's actually a checklist that the IRS includes on that of all the different items that need to be included in that. And you can see this slide here. This is really what they're looking for. Obviously, they want to make sure all the questions are answered, but these are what need to be provided in order for a complete application. So again, the user fee, making sure that you are filing on pay.gov. It has to be signed, making sure that you do have the EIN number that we talked about from your SS4. You need to provide financial information, a copy of the organizing document, which is your articles that we just talked about. You have to provide a narrative of your proposed activities and then a copy of your bylaws. So again, a lot of work goes into this. So that's why it's very important that your organization not do anything to lose your tax exempt status, because then you're going to have to go back and refile this again. If your organization expects to have gross receipts of not more than $50,000 in the next year, or you have had $50,000 in the most recent 3 years, and you are applying to be a tax exempt entity, you can file a more streamlined Form 1023. It's called a 1023-EZ. There are certain types of organizations that cannot file the 1023-EZ to receive their exemption. However, in general, it is based on the $50,000 gross receipts. Again, this form must be filed on pay.gov, and the filing fee is a little bit less than the full 1023 fee, but there is a fee that goes along with this. Both forms 1023 and 1023-EZ are open for public inspection. So that means if someone were to come to your organization and ask you for a copy of your 1023, you need to provide that to them. So this is a form that if you don't currently have a copy of it or don't know where it is, you probably need to find it to make sure that you do have a copy in case someone does ask you for it. Now, when you go to file your 1023, it's not something that you file today and you get a response back tomorrow. The IRS does take a while to get these completed. You can go to the IRS website and actually see where your application is. Most recently, if you filed a Form 1023, the applications have not been assigned if it's been postmarked after this date. So you filed Form 1023 online, because obviously it needs to be done online. If you filed that after April 6, 2023, they haven't even touched it yet. They haven't even looked at it yet. And you know, it's December already, so you can see how far behind they are. Obviously, the 1023-EZ forms, the shorter forms, they do get through those a little bit quicker because those are not as much involved with those organizations. So they're looking at ones filed before November 7th, 2023. So just to let you know, if you know of any or organization that is going to apply for the tax exempt status, this is kind of where the IRS is currently, and that is a large process that needs to go through. So, once you apply for an organization to be a tax exempt entity, the IRS will, once they approve it and say that you met all of the requirements, they will issue you a determination letter. It is very important that you keep that determination letter for multiple reasons, because that is your document that shows that you are exempt from income tax. So a lot of times funders will want a copy of that in order before they start granting you funds to ensure that you are a nonprofit, a 501c3 entity. So you want to make sure you have that. Your determination letter is also one of those items that's open for public inspection. So if someone were to come and ask you for a copy of your determination letter, you do have to give that to them. So if you do not have a copy of your determination letter, and you probably want to get one, and you can do that by filing Form 4506B with the IRS. So again, if you do not have a copy of your IRS determination letter, I would suggest filing this form to make sure you get a copy. Please note that it may take up to 60 days for them to process this. So it's not something that you're going to file today and get it back tomorrow. There are on the IRS website, and we'll talk a little bit later about this, under the tax exempt select check website under charities and nonprofits on the IRS website, there is a spot where you can go and look up organizations that are registered as tax exempt with the IRS, and you can see copies of their most recently filed 990s. You can also see copies of some IRS determination letters. However, it's only for those determinations letters that have been filed within the last I'm going to say maybe 4 or 5 years. So if your organization is relatively new and you have just recently filed with the IRS to become tax exempt and you don't have a copy of your determination letter, you may be able to go to the IRS website and get a copy. However, if your organization has been around for a while, that determination letter is not going to be on the IRS website, and you probably do have to file this form to get a copy. There's also a small fee for that as well. So again, making sure that you have your email, or I'm sorry, your copy of your determination letter. And you can either do it by email, mail, or fax. Again, I would suggest doing it by email because that way it's the most quickest route. And then the final form, that's kind of just a general form. Some people may or may not have already filed a power of attorney. So when you contact the IRS, if you have questions, whether it be on Form 990 or, you know, just general tax information, things that need to be filed, what you should do, that type of thing. Sometimes you want to get your accountant, your CPA involved. The IRS will not talk to anyone that is not listed as an officer of the organization. So for example, if you're a client of DWD and you ask myself or one of our nonprofit team members to contact the IRS on your behalf, they will not talk to us unless there is a power of attorney on file. So might be something to consider if you run into some kind of issue that you need some assistance with. Form 2848 is the form that does that. And when you fill that out, there is a spot that you know what specifically it is that they're going to talk, that you want them to talk to that person about, whether it be for Form 990 or for your 1023 application or whatever it's for, you note that on there. Just make sure that if you do need to have somebody talk to the IRS on your behalf, that this power of attorney is filed before you have them call the IRS. It does take a bit for them, again, to process this. So make sure that you file this and maybe wait a bit and then have them call, just to make sure that they have that on file. Because otherwise they'll end up calling and they won't say anything. They will not communicate, will not give any information to the individual. Next is the annual filings. It looks like we have a couple questions. The application, yes, you probably, okay, so you don't have a copy of your application, probably should be able to have one. If you, I mean, technically you're supposed to have one, but if you don't, you don't. But you really should have a copy of your determination letter. So that way, if somebody asks you for it, you can provide that. So if you don't have a copy of your IRS determination letter, you can fill out that form that we talked about to get a copy from the IRS. Having the copy of that determination letter does show and prove that you did at once file an application with the IRS. And then it does show that you do have, that you were approved. If you don't have a copy of the 1023, you don't have a copy. That's just a document that you should probably maintain, keep, but if you don't have it, you don't have it. Next is annual filings. So these are forms that need to be filed every year. And again, maybe not for every single organization, but these are more common ones that most need to file. Okay, so nonprofits do not file income tax returns, but they still have to file an informational return with the IRS. It's called Form 990. There are 3 different versions, well, 4 technically versions of Form 990. And which form your organization needs to file depends primarily on your gross receipts and assets. There are some organizations that are not allowed to file a 990N, but in general, those are very specific types of organizations. But in general, we go by the gross receipts and assets. So if you are a small organization and you normally have gross receipts of $50,000 or less, when we say normally, we look at the last 3 years, the current year and the last 2 years. If you have gross receipts of less than $50,000, you can file Form 990N. This is an electronic postcard. Again, all of these should be filed electronically. It is a very small form. It asks for name, address, contact person's name, and then also, do you normally have less than $50,000 in gross receipts? So it's a very easy form. If your gross receipts are more than $50,000, but less than $200,000, and your total assets are less than $500,000, you can file Form 990 EZ. This is called a short form because it doesn't have quite as many questions as Form 990. Form 990 is required for organizations that have gross receipts of greater or equal to $200,000 or total assets of $500,000 or more. And then private foundations, you have to file the 990 PF. You don't have any other choice. That's the only form for private foundations. If you are a small organization that does have gross receipts of $50,000 or less, and you want to file a Form 990, you can certainly do that. Sometimes organizations that aren't required to file a Form 990 still file a Form 990 because they provide that to funders, and that Form 990 provides a lot more information about the organization than a 990N or a 990EZ. Again, this is an informational return, not a tax return, so we're not calculating taxes. We're merely providing information about our financials and our governance and our policies and programs to the IRS. Again, no matter what form you file, it has to be filed electronically with the IRS. It is due by the 15th day of the 5th month after the organization's accounting period ends. So what that means is if your year end is December 31st, it's due May 15th. If year end is June 30th, it is due November 15th. There is an extension that can be filed. So if you cannot, for some reason, get the return done by the initial due date, you can file an extension. That's an automatic 6-month extension. Just make sure that the application for extension is filed by the original due date. If you have an organization that is terminated, it goes out of business, you do have to file a final return, a final 990, by the 15th day of the 5th month after that liquidation or dissolution. So that final return would just be, you'd have to include the activity for that ending period, and then all your assets would be zero. Your assets and liabilities would be zero because you've dissolved, everything has gone to another organization. Form 990N cannot be extended. So that is one, again, that's that small postcard that just asks basic information. So that one cannot be extended. 990 EZ, 990, and 990 PF can be extended. If you fail to file your Form 990, there are penalties and interest. You can see on the screen here the different amounts of penalties depending on the organization's size. Penalties can also be incurred if the organization files an incomplete return. So if the wrong return was filed, if not all the schedules were filed, if I just recently heard of one where the return was paper filed instead of electronically filed, and so the IRS considers that not a properly filed return. So that need to know that. If you fail to file a return for 3 consecutive years, you will automatically lose your tax exempt status. So we really don't want that to happen because your organization went through a lot of work to get to that tax exempt status recognition by the IRS. And so failure to file it would take that away. And again, you'd have to go back and refile that Form 1023, pay the application fees. In the meantime, you'd probably have to file a tax return as a for-profit. The donors would not be able to make contributions to you during that time. That would be deductible on their tax return. So very bad. We don't want that to happen. Now, if for some reason you do get a notice that you did not file the return on time, sometimes you can write a letter to the IRS and show that the late filing was due to a reasonable cause. So you just, depending on the circumstances, if there was a lot of transition, if it's a all volunteer board or all volunteer organization, there are some situations where if you did file a return late, you may be able to get out of those penalties and interest, but that's not guaranteed. All right. Again, because nonprofits do receive this tax exempt status from the IRS and exist for the benefit of the community, there are certain documents that they need to make public to the community, to the public. In addition to the application, the Form 1023 and the IRS determination letter, Form 990 is another document that must be made open to the public. So Form 990, 990EZ, 990N, the PF for private foundations, and 990T, which we'll talk about in a little bit here. All of those returns must be made available for the last 3 years. So if someone comes and asks you for a copy of your 990, you need to provide it to them. If they want a paper copy, you can charge them copying costs and postage costs as long as it's reasonable. Failure to provide this form, again, there are penalties up to a maximum of $10,000, which is kind of crazy. So there are penalties if you fail to make these items available to the public. One thing to note on your Form 990 and 990EZ. Schedule B is the schedule that lists all of your contributors during the year that meet certain requirements that need to be listed. They include the donor's name, address, and dollar amount. The names and addresses on Schedule B are not open to public inspection. So when you have your 990 prepared, either whether you do it yourself or have an outside CPA firm do it, make sure that you are getting a public inspection copy to provide to people outside of your organization that do not include names and addresses of contributors on Schedule B. If you are putting a copy of your 990 on your website, which a lot of organizations do, that's great. Again, make sure that you are not including the names and addresses of your donors on Schedule B, because those are not open to public inspection. So we talked briefly about, mentioned 990T. This is a form that is filed if an organization has gross income of $1,000 or more from UBIT. So again, organizations, nonprofit, tax-exempt entities are not required to pay income taxes. However, they are required to pay taxes on unrelated business income. I'm not going to go into a whole bunch about what unrelated business income is, but basically it's regularly carried on. It looks like a trade or business. If a for-profit entity is doing it, it's probably considered unrelated business income. It does not relate directly to your mission. You may have to pay taxes on that. So what we do is we take the gross income from that activity, less cost of goods sold, less any direct expenses, whether it be salaries or other costs related to that activity, to come down to a net amount. That net amount is taxed just like any other corporation at 21%. And you pay this taxes and file this return via the 990T with the IRS. A little bit of unrelated business income is okay for nonprofits. However, if it becomes a significant portion of your activities, the IRS does not like that, and it could possibly lead to loss of your tax exempt status. So just make sure that you know that if you do have unrelated business income, there is a form that needs to be filed with the IRS, and you do need to pay taxes on that. And if you do have estimated taxes that are $500 or more, you have to make installment payments, just like, estimated payments, just like a for-profit. Payments need to be made via EFTPS. So again, everything is electronic. Failure to file the return and the paying the payments, there are penalties and interest for that as well. Now, just like at the IRS, the federal level, there is a state return. So Indiana has an IT-20NP. So again, if you have unrelated business income of over $1,000 during the tax year, you do have to file a state return with Indiana Department of Revenue. It is due at the same time as the federal return. Currently, the Indiana corporate tax rate is 4.9%. So again, if you have unrelated business income, you have to pay both federal and state tax on that. Other than the IT-20NP for the unrelated business income, currently there is not a state return that needs to be filed. It's like similar to the 990. The 990 is filed with the IRS. There's not like a similar equivalent return that's filed with the state of Indiana at this time. Again, we talked about unrelated business, quarterly estimated payments, underpayment for penalty. So again, it's basically just like a for-profit corporate taxes is how unrelated business income is treated. It's just we call it unrelated business income as opposed to income tax. Another form that is required annually is the Form 8879. And I wanted to mention this just because I know a lot of organizations do have someone else, a CPA firm, prepare their 990. So this is a form that firm will provide to your organization to sign it. And then that way that firm can electronically file the form for you with the IRS. So basically it's just your organization giving permission for the firm to e-file the return for you. It needs to be signed by an authorized officer of the organization. This is what it looks like. And I know I've gotten questions over the years about where to sign it because they didn't do a real good job of noting where you actually need to sign it. So it's at the very bottom of part 2 here that I've highlighted. That's where actually you need to have the authorized signer sign that. And again, just giving permission to e-file the return on your behalf because all 990s do have to be e-filed with the IRS. Okay, next is the business entity report. This is actually not an annual return, but biannual. So every 2 years, you need to file this. This is filed with the Indiana Secretary of State, so it's a state return. And this is basically filed to maintain active status, that you are still an organization that's actively, doing business. It is due in the month that the organization was formed or registered. So they do send email reminders 90 days and 30 days prior to when the report is due. The email is sent to the email that they have on hand. So that would be either the business email or the registered agent email. So if that has changed, you might want to make sure that you update that every, when you file this to make sure it's going to the correct person. You can also go on to the Indiana Secretary of State's website under the business entity search and look up your organization, and you can see who they have as the contact person. And you can also see when your next business entity report is due. There's a fee, it's a small fee. Again, you can file it either by InBiz or paper. InBiz is the online electronic state system. Again, I would highly recommend that you file all of this electronically to make sure that they get it, make sure it's filed timely, and yeah. Oh, and if you fail to file this return with the IRS, with the Indiana Secretary of State, the organization will be administratively dissolved, which again is not good, because then you'll have to go back and file your articles, reinstatement, and that type of thing. So we want to make sure that these are filed. Again, this is just basic information about, who the board members are, organization's name, email, that kind of thing. Now, we also have what's called an entity annual report in E1. Now, don't get this confused with the annual report that we just talked about. This is also a state return, and this needs to be filed by organizations that receive government assistance. So whether it be federal, state, or local, if you're a nonprofit and you receive government funding, again, whether it be from the federal government, a local government, or a state government, you need to file this form with the state. What the state does is then looks at this form and determines whether you need to have an audit done. And they do a calculation. It's based on your total disbursements and where you're getting your money from, and they will let you know if you need to have an audit done. So it is filed online, again, through the Indiana Gateway, and I have the link here. It's due within 60 days after the entity's fiscal year end. So if you're December 31 year end, then it's due, within 60 days, February 28th. You submit the report, you submit the numbers, the dollars that they're asking. After you submit the report, you will be notified via email if you need to have an audit or if you qualify for a waiver, so you don't need to have the audit. Sometimes they say you don't need to have an audit. If you do have to have an audit done, you will be required to submit that contract, the engagement letter, to the Indiana State Board of Accounts for their review and approval. And then also a copy of that final audit report will be submitted to the State Board of Accounts as well. And so that the reporting back. When we talk about government funds that are reported on the E1, when you fill out the E1, it's going to ask you different questions. And then under the government funding, it's going to have 4 different sections. The first is a direct federal grant. So this is when you get a a grant directly from the federal government. So there's a federal agency and they're paying your organization directly. That's a direct federal grant. We also have what's called federal grant pass-through state or local government. So the money, the funds they start at the federal government. The federal government is going to pass those on to the state of Indiana or to maybe Allen County or the city of Fort Wayne or the city of South Bend, to some state or local government. And then it's going to go to you. Because those funds initiated with the federal government, they are going to be considered federal funds and they fall under this category. There's also a fee for service. So fee for service, again, are payments from federal, state, or local government entity. But when they pay you, they don't just say, hey, here's $50,000, go do XYZ, or here's $50,000 for this program. It's more of, we're going to pay you a per diem or a per unit rate for these services that you're going to provide. So maybe you're going to provide some housing counseling for people, and you're going to get paid $100 for each counseling session that you have. So that would be considered a fee for service because you're being paid on a per diem or a per unit rate. And so those fundings would go under this category. And then finally, we have state and local. So again, if you have money that initiates from the from a state, the Indiana state government, or a local government, again, county or city, town, that would be recorded under this category. This is what, when you go to log on to the Indiana Gateway, because I know this sometimes is confusing or new to some people, I wanted to show you what it looks like. So this is what the website looks like. You do have to set up a username and password to log in, but this is where you would go in and submit that E1. And then once you, if you do have to have an audit done and you submit that to the Indiana Gateway, you can actually go on to the Gateway, or anyone can go on to the Gateway and look up both audit reports and the entity annual report. So you can go on, and this is what the screen looks like there. So I know that there are some, again, this may be new for some people, so wanted to bring this up so that if you do get government funding, that this is something that does need to be reported. Yes, I know, Sherry, the Gateway is not very user-friendly at all. Yes, schools and libraries do count as government because they are government entities. So they probably should be reported. Now, again, if you do a fee for service for those, you put those under the fee for service category. And usually if it's a fee for service, it's like if you were just getting a fee for service, they don't usually require an audit. I'm not going to say that all of the time, but that's usually how it works. If for some reason you got money from another nonprofit, so let's say you got it was federal money that went from nonprofit A and then it came to your nonprofit, you do not have to report that on your E1 because it went through another nonprofit before it came to you. I think that's a little bit different. I'm not sure why they do it like that, but if the money comes from a federal, state, or local government to another nonprofit and then to you, you do not have to report that money on your E1. Okay, next is sales tax. And I don't know if you are all aware of this or not, but effective July 1st, 2022, the state of Indiana decided to make a bunch of changes on how nonprofits paid sales tax, collected sales tax, and were exempt from sales tax. And I don't think it went over as smoothly as it could have, or they thought it would. So before July 1st, 2022, if a nonprofit sold tangible items for less than 30 days, it was exempt. We don't care. You don't have to collect sales tax. You didn't have to do anything with it. It was basically ignored. It was exempt. 30 days counted as, it didn't have to be 30 consecutive days, just 30 days within the year. So then July 1st, 2022, they passed this law and it says, okay, we're not going to do the 30-day rule anymore. We're going to look at dollar amount. So we're going to say that if you sell $20,000, less than $20,000 a year of tangible personal property, it's going to be exempt. Once you hit the $20,000, you have to start collecting and paying sales tax. Well, then a little bit later, still within the same year, they decided to change it and said, okay, no longer, we're not going to do 20,000 anymore. We're going to increase that to $100,000. So current law is if you sell less than $100,000 of tangible property within 1 calendar year, you are exempt from collecting and paying sales tax. Once you hit that $100,000, you have to start collecting and paying sales tax. So now what that means is you're not going to be like selling stuff and then all of a sudden, you get another dollar and it's $100,000. And right then is when you have to register. It's when it would be like the next event. So let's say, for example, you've had a couple events and you've sold items during the year, and so far you've sold $75,000 worth of items. Okay, you have another event and now you sold $30,000. So that triggers you're over $100,000. So then the next event you have, or the next time that you make a sales, that's when you have to start collecting sales tax, and you start collecting sales tax on that going forward. So that is a change. They also changed it to say that there are some specific exemptions. So if you are a church, a monastery, a convent, schools, public schools or private schools, or a youth organization focused on agriculture, which is FFA. If you are one of those entities, the $100,000 doesn't apply to you. You never have to collect and remit sales tax. So that was a change there as well. Now, when we're talking about sales of tangible property, we're talking about all sales made by all units of the organization. So this includes like your sale of your t-shirts, your hats, your mugs that have your logos on it. Those are tangible items. Now, one other thing that nonprofits sell are tangible items at fundraisers. So when you have an auction and you sell, a signed football or, a nice grill, those are tangible items. The way that the law reads now, those items would be included in this tangible personal property sales. And once you sell $100,000, those items will be included there. Once you sell $100,000, you're going to have to pay sales tax on those. So again, as the law reads now, you may have to collect and remit sales tax on tangible items that are sold at an auction during a fundraiser. I don't know if that's how the law was intended. I have had some conversations with the people at Indiana Department of Revenue, but as the law reads now, tangible items that are sold at auctions at fundraisers would be included in tangible sales for nonprofits and would be included in that $100,000 calculation if you got to that level. Now, as it has always been, sales of items such as periodicals, books, other property that are used primarily to further the educational, your mission and purpose, those are excluded from sales tax, and they always have been. So that's not anything new. So once you do reach that $100,000 limit, you have to register with the Indiana Department of Revenue and get a retail merchant to make sales. But once you register, once you need to collect sales tax, you have to register with the Department of Revenue, set up an account, do it through inbiz.in.gov. There's an application fee. And then once you have registered and start collecting sales tax, you have to file Form ST-105 to report your monthly sales and the amount that needs to be remitted each month. Once you have been set up and have an account, if you do not have sales for that month, you still need to file the return. It's just a zero return to make sure that they have everything proper for that period. So that is sales by nonprofits. So now we have purchases by nonprofits. So again, they changed some of this. To qualify for a sales tax exemption on purchases as a nonprofit in Indiana, it does have to be a qualified nonprofit organization, and these have not changed at all. There's a qualified nonprofit. You must be not operated predominantly for social purposes. The purchase must be used to carry out the nonprofit's purpose. and it must be invoiced directly to the nonprofit. So that is one thing that sometimes I see. If you have an employee and you send your employee to Walmart to buy supplies for your program, technically, if that employee is paying with their credit card and getting reimbursed, they really should be paying sales tax on that. So what you want to do is make sure that Walmart is invoicing your nonprofit, or that it is on the organization's credit card, because again, it must be invoiced directly to the nonprofit to be exempt from sales tax. When an organization initially is formed, they are going to want to file Form NP-20A with the state of Indiana to be exempt from sales tax. So again, when they go and purchase those items for their programs and their organization, they don't have to pay sales tax on it. So this is the form that most of your organizations probably would have filed many, many years ago when you first became a nonprofit. But now they made a change. So July 1st, 2022, of course, they got to change something. In the past, there's been ST-105, and that's been the form that's filed, and your sales tax exemption, that you go and show your vendors that you don't have to pay a sales tax. Okay, that is no longer. So effective December 31st, 2023, in a few weeks here, you can't use that anymore. That gets replaced with Form NP-1, an exemption certificate. You obtain this through InTime. So you have to set up an account on the Indiana Department of Revenue's InTime website. And an NP-1 has to be completed for each vendor. I know that's different. In the past, the ST-105 has only been one form that you can take to each vendor to use. That's no more. You have to get an NP-1 exemption certificate for each vendor. I know that's a little bit more work for the organizations, but that's how they decided to do it moving forward. This NP-1 provides documentation that you're registered and that you are exempt from sales tax. Now, also in the past, your organization has had to file Form NP-20 every year. Usually, that has been due the same time as your 990, and basically that it was filed with the state of Indiana, and it was basically filed to maintain your sales tax exemption. Again, that is no more. So moving forward, it's going to be a new form. It's called NP-20R. It is filed with the Indiana Department of Revenue through InTime, so it has to be filed electronically through your InTime account. The first NP-20R is due based on the last two digits of your EIN. So if you were to look at your organization's EIN, and if your last two digits end in 00 to 24, your first NP-20R is due May 15th, 2024. And then you can see if your EIN ends in 25 to 49, you do not have an NPR due until May 15th, 2025, and so on, so forth. Moving forward, this NP-20R, which again is your report that is related to sales tax exemption for Indiana, is due May 15th every 5th year going forward. So it doesn't matter what your year end is, all nonprofits NP-20Rs are going to be due on May 15th, and it's going to be due every 5 years. So if your first one is due May 15th, 2024, your next one is going to be due May 20th, 2029. So this again is something new, making sure that you do have this on your schedule and that you do have an InTime account set up. So that way you can go in and file this electronically. Okay, so those are kind of the annual forms. And again, we're not talking about every single one, but more of the most common popular forms that organizations have to file. Next, property taxes. So as a nonprofit, you have to report property to the assessor, and it is normally taxed unless you file an exemption. And this, when we're talking about property taxes here, that's reported on the forms. Real estate is not, computer application software is not, inventory is not. So nonprofits can file for an exemption from paying property taxes in Indiana. The key is, though, just because a nonprofit owns property, they're not going to automatically be exempt from paying property taxes. The organization, first of all, the property has to be owned, occupied, and used by a 501c3 organization. There are some instances where other types of nonprofits may receive a partial exemption, just depending on the use and how the property is occupied and such. But again, just because a 501c3 organization owns property, it doesn't mean it's automatically going to be exempt. They look at who owns it, who occupies it, and who uses it. And then same with personal property. You can see here the code that if it's owned and used in such a manner similar to the buildings listed above. So when you purchase a building or are initially started up and start owning personal property, you have to file an application for exemption. It's called the Form 136. It's filed with the county assessor in which the county, where the property is located. It is due April 1st of the assessment year. There's no fee, but it reports information about the property, who uses it, how often, the exempt purpose. Again, they want to know not only that it's owned by the nonprofit, but what it's being used for and who's using it. Along with this exemption, you have to submit your articles, your bylaws, and financial statements for the last 3 years. If you are filing for an exemption from property taxes for a building, you also have to file a predominant use worksheet, which is a bunch of questions on the property, the square footage, how much of the square footage is used for different purposes. So it does take a little bit of work. In the past, it used to be that nonprofit organizations had to file an application for exemption every 2 years, and several years ago that stopped. So once you file your application, you don't need to file it again unless you buy new property at a new address. You're going to have to file an application for exemption, or if you've moved to a different location, then you're going to have to file an application for that new location. If your organization has a change in ownership where you owned property and you had an exemption on it and you sold it to somebody else, like maybe a for-profit, or that new owner is not using it for the same purpose, another form called a notice of change of ownership or use of exempt property needs to be filed with the assessor. And then that notifies the assessor that, hey, our nonprofit doesn't own this property anymore. We're not using it for our mission. Somebody else is now using it. I want to talk briefly about the $80,000 exemption. So nonprofits, you can file, again, this is in Indiana for property taxes, an exemption because you are tax exempt. There is another exemption for for-profits and nonprofits, the $80,000 exemption. So this says that if the cost of your total business property is less than $80,000, you can file under this exemption. You do have to file a Form 103. And then once you file this, and as long as you continue to have $80,000 or less than $80,000 of property, you don't have to file a return. Now, the thing is, it's either or. You can't have a nonprofit tax exemption and an $80,000 exemption. If you were to file this $80,000 exemption, then your nonprofit tax exemption for property taxes goes away. And if you were to somehow get over $80,000 of property, let's say you've bought a whole bunch of property this year, now you have $100,000, you have to pay property taxes on that because your tax exempt nonprofit property tax exemption went away. So this one overrode that other one. So a lot of times I will recommend to nonprofits to just use the nonprofit exempt status exemption, because yes, you still have to file a form every year, but you are a nonprofit, so you won't have to pay taxes on it. You don't have to worry about that level of where your property is. It's totally up to the nonprofit. If you have very small amount of property and don't expect your property to ever go over $80,000, you could certainly, get rid of your tax exempt status and use the 80,000, or I'm sorry, not tax exempt status, but tax exempt exemption, and use the 80,000 exemption. You certainly could, but I do wanted to make that clear that, it's one or the other. It's not both of them. So when you do file your Form 104 property taxes, it's on Form 104. So even if you do get an exemption as a nonprofit, you still have to file the return. You just don't pay property taxes. So it's due, their property taxes are due May 15th. There's no extension. So you do have to make sure that that is in by the May 15th deadline. Basically reports all of your tangible personal property that you have. 103 goes along with that. So it's Form 104 and 103. If you have leased property, there's an additional form 103N and 103O that needs to be filed as well. Churches, effective for the January 1, 2023 assessment date, churches, if you have filed your personal property tax return for the previous 5 years and you are a church, you no longer have to file property tax returns. So that again is something new. Payroll taxes, I left all of these in here because I wanted you to have the information, because again, we will send out the slides. I'm not going to go through each one of these because a lot of you are very familiar with the payroll forms. I did want to point out a couple things though. In Indiana, nonprofits are only considered an employer if you're a 501c. So 501c3, we're talking about 501c3 organizations. You are considered an employer if you employ 4 or more individuals in 20 different weeks during the same calendar year. So if you only have 1 employee, technically you are not considered an employer in Indiana. So I wanted to make sure that everyone knew that. And then also I wanted to talk about want to remind everyone, as a 501c3 organization, you're exempt from paying FUTA, federal unemployment tax. So make sure you're not paying that. But at the state level, nonprofits can choose, 501c3 organizations can choose to be a reimbursable employer, which means that you don't have to pay in as you go. You only pay in if there's a claim. In order to do that, you have to file this form with the Department of Workforce Development called 1065 Election to Pay. However, it really needs to be, should have been, when you initiate it as a nonprofit, you can file this form. And it basically, it just means that you don't pay in you don't pay in state unemployment each month. You just, when you do payroll, you just make payments in when there's actually a claim against your organization. Once it's elected, the status cannot be changed for a minimum of 2 years and will remain in effect until the employer revokes the election. So that is kind of a unique aspect of nonprofits. And then the final thing I did want to talk about real quick, because I know we're running out of time, is reporting changes to the IRS. So sometimes there are things that happen within your organization and you really need to make sure the IRS is aware of that. A request for miscellaneous determination, sometimes an organization changes the reason that it's a public charity or its public status. So when you first became a nonprofit, you were either determined to be a private foundation or a public charity. The reason that you're a public charity is because there's several different options. Sometimes those things change. A lot of it is determined on where you're getting your money from, your funding from. Sometimes you need to change that. And so this form here would be something that you would file in order to change that. And this primarily relates to the Schedule A of the Form 990 that's filed every year, and that public support test that goes along with that. If you want to change your accounting method, so for example, the accrual basis or the modified cash basis or cash basis, you do have to notify the IRS about that, and you use Form 3115 for that. If you have a change in address or a change in responsible person, you want to make sure that the IRS is aware of that, because it's very important that they are sending all of their notices, letters, and such to the right individual. So you can use Form 8822 to do that. If you have a name change, you generally report that on your Form 990 or Form 990EZ. However, if you don't file a 990EZ or 990 and you file a 990N, you can contact the IRS either by letter or fax, not by phone, and notify them of that name change. Again, you have to include a copy of the amendment to the Articles of Incorporation. So this would be one reason why you would file an Articles amendment with this Indiana Secretary of State, would be for like a name change. And then also included in that letter or fax, the current name, the prior name, EIN, and then somebody from your organization has to sign it as well. So I know those last items were pretty quick, but all of that information is included in the slides that we'll be sending out to you. So you do have that. So wanted to thank you for attending, and I'll turn it back over to Tyson.
Thank you, Carrie. So just as a reminder, like Carrie said, webinar is recorded and the video will be available on our website in the not-for-profit section. A link to this section is going to be emailed out here after the presentation along with Carrie's slides. So today was our last webinar of the year. We don't really have any webinars scheduled upcoming. We're working on that schedule right now, so we're kind of working out our topics and the timing for 2024. So keep a lookout for that information. It'll come out soon here. And I want to thank everyone for joining us, and have a great rest of your day.